CNBC senior economics reporter Steve Liesman has the very latest. Hi, Steve.
Hey, Kelly, thanks. Yeah, futures markets quickly priced out a summer Fed rate cut after the U.S. deal with China for a 90-day pause from the most extreme tariffs. Markets pushed ahead the first cut to the fall, now see just 2 cuts this year. Meanwhile, comments from a Fed governor suggest the economy, at least in her opinion, is not completely out of the tariff woods just yet. So the probability of the first cut coming in July has fallen to 42% from 69% on Friday. September now priced with an 82% probability of that first cut. A second cut now in October. Just barely priced in, maybe a little bit towards the 60% weight, with more confidence in December. And the third cut in December is now priced out. Markets clearly bet that the Fed would meet the stagflation threat by ignoring inflation and addressing the weaker growth side. The Fed last week threw some cold water on that, saying risks to both higher inflation and unemployment had increased. Well, the risks to both would now seem to be lower, though they have not yet disappeared. Adriana Kugler, Fed governor, said at an event this morning that even at current tariff levels, the economic effects will remain significant from the tariffs. There could be some permanent tariff inflation effects that she's concerned about, but hard to judge the pace of U.S. economic growth because of the impact of front-running of tariffs and the decline in expectations. Policy, she says right now, however, is well positioned to deal with either eventuality. Despite the agreement, some tariff-related price increases will still hit the economy. 30% tariffs on China, still pretty high, and uncertainty now extends 90 days out. But clearly, recession odds have declined. They're lower now, and it would seem the possibility, this could be key, of lower tariffs on other trading partners have increased. Kelly?
Do you have a feeling, Steve, of how all this now is shaking out in terms of, as we hear from Fed officials and so forth? Is it a coast is clear kind of signal for the economy, or are people still mired in confusion and concern about, what exactly is going to happen on the tariff and trade front?
I think it's more the latter, but the extent to which they're confused and concerned has probably gone down. Look, Kelly, there's another way to think about this, which is I think the Fed had wanted to cut, all things being equal, because its policies were restrictive. We've actually had 2 pretty good CPI reports in a row, and that probably leads us to a pretty good PCE report at the end of this month. If that's the case and the tariff threat is lower, I'm actually reversing my thinking that there's a higher chance the Fed could cut rates sooner. But I was on the other side of the market on this. I thought the market was overstating the extent to which the Fed was going to address the stag and not deflation. I thought the Fed was going to remain on hold a lot longer. Some economists agreed with that point of view. So the idea that tariffs become less distortionary does clear the way for the Fed to react to, in my opinion, the real inflation story underneath the economy. And if that direction is lower, I think the Fed could make cuts perhaps sooner based on what it sees to be hopefully real inflation and not tariff noise.
Wow, Steve, I feel like this is worth a headline. That's the most dovish I've heard you in quite some time. And to your point, I mean, the market's taking it as this will on the margin be better for growth. And therefore, I think rates are moving higher and the rate cut odds get priced out. But you're saying this is better for growth in the disinflationary way that the administration's kind of hoping for, frankly.
Right. Well, let's say, for example, that some of the lower oil prices remain. Obviously, oil's a little bit higher now, but remember, it was at 70, went back down to 60 on weak concerns. I thought the market thought the Fed was really going to just address weakness and ignore the inflation part. But when Powell steps to the podium and says, I have to make sure there's no secondary effects to the tariffs before I can do anything. That, to me, said hold, even while the market was heavily pricing in rate cuts amid what I thought was this period of confusion that was going to be out there where the Fed couldn't act. Well, let's just say we get to a point, and we're not there yet, where the tariff regime is more clear, where you can start to think about estimating or forecasting the tariff effect on inflation, and you have this decline, for example, in inflation expectations, you get to a better place where the Fed can do what I believe its bias is, which is to bring down rates to a more neutral rate in the face of declining inflation. So I hardly think what I think is worth a headline, but I think it's a different way to look at it.
I think it is. I love the way that you put that. This is a big change in tune, and I think it's just important to highlight as everyone's kind of thinking about what the outlook really is now. Anyway, I will leave it there. Steve, thanks.